Good evening, ladies and gentlemen. Welcome to the second Equitymaster Web Summit. Our guest today is Ramesh Damani. Ramesh, as you know, is probably one of India's most rational voices on investing, and that's why we thought we should have him here at the start of the new year. Ramesh is also a broker at the BSE, but he's known more for his stock picking. He has a fantastic track record, and we hope to pick his brains on that. With these words, Ramesh, welcome to the Web Summit. How does 2009 feel? It's been a couple of days already.
Thanks, Rahul. It's a pleasure to join an innovative medium to reach the public, and thank you for inviting me. It's very kind. Your introduction is very kind to me. How did 2009 start? I mean, we're recording this for your interview, so it has started out well. I think there's some bargain hunting going on in the markets after an absolutely brutal 2008. But unfortunately, if you step back and say what's going to happen for the rest of the year, it still looks like the market has a long way uphill to go, and uphill I'm talking, defining in terms of 21,000 Sensex, we're closer to 10,000. So there's a long, many milestones for the market to reach, and it's going to be a very, very difficult year, probably one of the more difficult years, because 2008 was marked by volatility. So you had great runs and great falls in almost all asset classes, be it oil or be it equities or be it bonds. But in 2009, we might be approaching a period of very poor volatility and very dull volumes, in which case it's going to be very hard to make money. So I think people will move away from the financial world and all the derivatives and all the layoffs that you did and move into the real world, which is good. I mean, it can't be too bad, but it could happen.
Yep. Okay, so stepping back a bit now, what's your reading of this current global crisis, and how deep do you think, how bad do you think it will get before it gets better?
The malaise is pretty deep, to put it very bluntly. I mean, if you look back and think about, as we correctly stated, that life must be lived forward but understood backwards. The same is true of markets. They must be lived forward but only understood backwards. In perspective now, we look what happened in 2008. This was a super cycle of the credit boom that took 25 years in the making, from 1980 to 2008, 20-year bubble. And each year you saw credit card growth grow, home mortgages grow, emerging market flows grow. Almost all credit matrices were growing very dramatically over the last 20 or 30 years. So that cycle is about to reverse itself. And we are already seeing that in terms of deleveraging. Once liquidity is not available, whether it was in the tech boom in 2003, you could see a lot of the tech stocks have not come back anywhere close to their highs in 2003, despite 5 years being passed. So we're having a massive deleveraging taking place in the real world. Money that is so freely available to, say, a used consumer to buy mortgages, autos, cars, credit cards, is no longer going to be available. Money that floats so freely into any idea in emerging market, any private equity, is not going to be available. So generally, it spells a depressed period of economic activity. Right now, there is bargain hunting. There, typically in the middle phase of a bear market, Rahul, you will find that stocks were bid up on talk of a recovery. And I use talk in the quote-unquote sense, because right now there's a talk of a recovery. The worst is in the price, it will go up. But if you go back and study the history of bear markets, it takes time. I mean, time is the single biggest element of a bear market. It wears you out. People are not going to find a bottom when everyone is looking for a bottom.
Okay. And a lot of comparisons are now being made with the Great Depression, of course, in the US and the Japanese experience. What's your take? How do you think those?
Yeah. It's very common to capture 1929 and say this is the worst crisis since 29, because it is the worst crisis in 1929. But I think, as it's been also said, that history does not repeat itself, it rhymes. And I think policymakers from the 1929 experience or the 1989 experience in Japan have learned, and I think if you go by what the current Fed chairman says, Ben Bernanke, he was schooled in the area of Great Depression. The point is that in American economic thought, and I've lived in American society for many years, there are 2-3 things that stand out in American national psyche. One was, of course, the Great Depression, as you mentioned, 1929. One was, of course, when, say, JFK died. One was, of course, when the Twin Towers happened. And the party that was in power during the Great Depression didn't come back to power for the next quarter of a century. So every American policy, every American president is geared to make sure a Great Depression doesn't happen again. So in a $15 trillion economy, they've flooded the market with $7.5 trillion bailout package. $1 trillion from Obama, $3 trillion for the financial institutions, another $3 trillion coming up. So it's a huge stimulus being provided for the package. And the Treasury is basically has a mandate to print as much T-bills as they want and sell it as long as people will buy it. So while we think that the initial impetus for the next quarter, 2 quarter will be deleveraging as people sell off assets, do mark to market, I think longer term the greater threats to the market is not from deflation but from inflation.
Very interesting. And how do you see this impacting India, or rather how insulated or coupled is India with all this that's happening in the US?
Well, we're clearly not as bad as China. I mean, in China you can almost draw stark parallels that every time an American doesn't buy a car or American doesn't buy a house, the Chinese consumer factory is impacted. So I think clearly the worst off is China, Singapore, Korea, the Asian tiger, so to speak, compared to India. India has a vibrant domestic economy, but our services will be affected. And at the end of the day, India also needs its structural reforms, its labor reforms, its insurance reforms in order to grow again. And whether we have the political will to do that or not, depending on the outcome of the election, which will take place in 2009, remains to be seen. So I think while we are decoupled, we are coupled less than, say, China is or Singapore is, I think we're still coupled. And as the saying goes, that no man or no country is an island to itself. So I think if the global economy slows down, it's hard to believe that the hurricane won't affect India.
What's the worst case scenario for India?
I think the worst case scenario is we go back to the lows in October, perhaps break that by a little bit. Clearly at some point values do begin to emerge. The thing that I've learned from my experience is that stocks can remain overvalued for a long period of time, but stocks can also remain, conversely, undervalued for a long period of time. There's nothing to say that because stock is undervalued, we recognize immediately and put up. I can give you examples of old economy stocks in 2000 to 2003 period. They have not participated in the tech bull run and they remain grossly undervalued for periods of time. And then a new bull market starts and these values are discovered and then they go off to the other extreme. Larsen in his lifetime history probably hadn't cost 300 or 400 rupees for a 10 paid up share. After split it was available at 180 rupees. So in his lifetime it had never crossed that peak. And this bull market, because it was led by infrastructure stocks, Larsen went up 60x after that. So there can be huge periods of time when stocks remain hugely undervalued. So the idea that just because value is there, people will emerge and buy these stocks and they'll come to fair value is a misnomer, because stocks remain overvalued and undervalued. So there is no such logic that say undervalued stocks will go up immediately.
So what are you looking at when you see the stock markets now in India? What are you looking at from a short-term perspective? What are you looking at from a long-term perspective?
See, from a short-term perspective, for markets to go down and break the lows or test the lows that we saw in October of 7,700 on the Sensex, the market has to become heavy again in terms of outstanding position or in terms of public interest. All those factors are not there. So which suggests that we might have a good rally into the new year, maybe taking the Sensex back to 12,000, 12,500 level. I would certainly not rule that out. I think it's possible that the index can go up to that level. Public will come back, return, that the economy is recovered, markets are fine. Let's go back to our own example in India, and we're talking in aggregate terms, not in terms of individual stock, which can of course continue to defy the market. In 92, during the Harshad Mehta bull run, the Sensex was 4,500. It did not decisively cross the level until 2003, a period of 11 years, and in aggregate no one made money in the Indian stock market. That's the bad news. The good news is that during the time people who invested in 95 in Infosys or in PSU stock made 10, 20 times the money when the stocks finally broke out. So it's not necessarily a bad time to look for stocks, to look for bargains out there. But as an aggregate, in terms of the Sensex index, we may not see 21,000 for many, many years beyond 2009.
Okay. You mentioned about how this 11-year period happened. One thing which strikes out to anyone, even an amateur, when he looks at a chart, is the predictability with which these Indian stock markets peak. You had 92, you had 94, then I think in 97 there was a rally, then 2000, then 2004 it peaked, in 2008. What kind of a sense do you get? There's so much predictability in the way Indian stock markets keep going up and down.
We're part of a global cycle. If you look, for example, when Dow broke in 1982 1,000, it hadn't crossed 1,000 since 1968. So for a period of 14 years, the Dow traded between the cycle.